Thank you. Good afternoon to everybody. Welcome to the 6th Annual Conference on FinTech and Digital Innovation by Afore. And as it has been already said, my name is Andrej Kovačić, and it's my big honor and privilege to moderate this panel called Challenging the Traditional Financial Services Distribution Models with prominent speakers. So before I will jump in and introduce you our speakers, just very quickly, we will go through a couple of issues with our speakers before being able to answer some of the questions that you may have. So I definitely encourage our audience to raise questions in the chat throughout our initial discussion, and we will definitely turn to them with our panelists and try to find answers in the later part of our panel. So let me start with introducing you our speakers, which are today. We have Jan Seesens here with us, who is head of the Digital Finance Unit in the DG for Financial Stability, Financial Services and Capital Markets Union, DG FISMA in the European Commission. He's been with the Commission since 2006 and has held several positions, including in the Cabinet of Vice President Dombrovskis and also in the Cabinet of Vice President Barnier. So welcome, Jan. Let me welcome my colleague and fellow member of the European Parliament, Stasys Jakeliūnas from Lithuania, who is a member of the Econ Committee, the Economic and Monetary Affairs Committee, and chair of the FinTech Working Group in the European Parliament. Stasys is definitely not new to economics. He initiated and led the parliamentary inquiry into 2009-2010 economic crisis in Lithuania, and previously he worked for 10 years as investment manager and CFO for the largest insurance group in the Baltic states. So good afternoon, Stasys.
Yes, hello, Andrej, and good afternoon to everyone. Nice to be here.
Excellent. And let's move outside the EU bubble. And I'm glad to introduce Mr. Ravi Bhalla, who is head of Department for Innovation within the UK Financial Conduct Authority, where he's leading the FCA's market innovation services, including regulatory sandbox, advice unit, and direct support functions, as well as the FCA's engagement with domestic and international fintech ecosystems and digital policy. He has over 6 years of management experience across telecoms, insurance, financial services in both industry and consulting. Welcome, Ravi.
Thank you. Thank you for the invite.
Excellent. Now moving to our next guest, Mr. Jeffrey Brown. Jeff is a senior vice president and head of Schwab's Office of Legislative and Regulatory Affairs at Charles Schwab. He has over 3 decades of securities market experience and leads Charles Schwab's Office of Legislative and Regulatory Affairs. Welcome, Jeff.
Thank you, Andrej, and thank you all for having me here today. I'm sorry I'm not in Brussels, and we can't do this in person. You know, in fact, the last time I was there at this conference, it was several years ago. It was 70 degrees in Brussels, and so I want to come back to Brussels in February for warm weather. So, but I'm happy to be here today.
Thank you. We're glad to have you with us. And yes, as it has been said before, let's hope for some better times to have in-person meetings again. And finally, let me also welcome Mr. Jorik Neff, who is the CEO and co-founder of Buix, Europe's fastest growing neo-broker. After starting his career in investment banking, he made his way to neo-brokerage as one of the first hires at Buix. From day one, Jorik has responsible for the mobile brokers operation. Welcome, Jorik.
Thank you very much for having me, Andrej. Really happy to represent the commercial side of the neo-brokerage business. Also regret to not be in person in Brussels. I worked in Brussels myself for 1.5 years. I love the city, so now I'm based in London, but very happy to for the next maybe Afore panel maybe next year to be there in person instead of doing this virtually.
Indeed. Let's hope for some better perspectives. But coming back to our panel, and I'm really thrilled actually to have all of you with us today. Now we have all our panelists, and I think it's just about time to start our discussion. Just let me please remind our audience once more that you can and you are encouraged to ask questions using the chat function, and we will make sure the panelists answer them at the end of our discussion today. So maybe to slowly diving into the topic, I would like to start from the institutional point of view, and maybe perhaps start with Jan Seysens. Does the emergence of new digital intermediaries raise particular or unique challenges to regulators and supervisors in the financial services industry? Jan.
Thanks very much, Andre, and thanks indeed very much for facilitating the discussion today. Well, I think we just received, and Jose Manuel just mentioned it, we have just received, I think, 50 or 60 pages of really thick and very thoughtful advice on let's say, how the digital transformation is actually changing the system. So I think the answer is clearly yes, indeed, it changes it, and there are also quite some challenges linked to it. And we are, of course, closely studying this excellent work from the supervisory authorities on our side. But I mean, above all, maybe let me say, this is not just a challenge, but it's also a big opportunity. I mean, how many years have we been working to try to allow people to shop across borders, to not have just the bank around their corner available today? That is possible. How many years have we been trying to allow people to actually have more data and more information on what investment they buy, what's maybe the environmental impact of their investment, etc. And today they have all this data possibly just at their fingerprints. So I think I would start to say, first of all, this is really a big opportunity for many of the investors and for the intermediation itself as well. This can just actually has the potential to actually just make sales and intermediation quite a lot better. But of course, while we have to kind of long work for this, of course, some of the kind of the side effects that comes with are maybe not exactly as desired and as hoped, and that's simply what is then, of course, the big new challenge for the regulation. Just mentioning, and we'll come back to it. Certainly, the opportunity for much more direct access, especially of young people to capital markets. The challenge also for the supervisors of having to deal not anymore with the one bank, but with all its input upstream firms and all the platforms where the products are marketed downstream, and then all the algorithms with the bank is maybe using to help itself to provide advice, etc. So this is simply, let's say, a big challenge. And I think thirdly, also, of course, the issues, and Jose Manuel also mentioned it, around then new, let's say, competition issues arising in this. So there are quite a number of issues around which are raised by this, and which I think will provide plenty of the material now for the panel. But I think above all, I want to start by saying that this provides many opportunities, especially for those who are, as we, I think, all interested in integrated markets in Europe and beyond that.
Indeed. Thank you, Jan. Maybe just a quick follow-up question regarding the existing rules, those that are covering the marketing and distribution of financial services products. Do you think they are still appropriate, or do you see a need actually to adjust them, or actually complete them with some additional ones regarding and also the link to that the supervisory approach, so that it's actually fit to the situation that we are currently in, and the situation that we will most likely find ourselves in the future?
Yeah, I think, I mean, in the end, you need to look what is distribution and, let's say, marketing, also advice in a way. What is this in the end about? It's in the end about allowing consumers to find the right product which fits their needs. And so in that sense, it's in the end about meeting their needs, basically. So clearly consumers are changing in the digital age. Even I feel outdated when I look at how my kids actually interact with their computer. And so in a way, of course, you need to look at whether the rules are still actually fit for protecting. They may have been fit for protecting us, or maybe my grandparents. Will they still be fit for protecting my kids with their completely changed behavior? That's something which you need to look at. And I think the advice we received from the supervisory authorities is I think one important piece there. You know also that the Commission is indeed preparing a retail investment strategy later in the year, where we will certainly look at all those matters. So absolutely there is need for adjustment and change. And I mean, again, I think just to mention some of the issues, certainly it's indeed for me the very fundamental question. Well, how can advice and in a way information still be meaningful for people who have a very different, much faster actually investment behavior? Maybe also some would say less, more gameful investment behavior. How can you still reach these people with meaningful actually input and advice? And how can you also make sure that this new ecosystem is still, let's say, reliable, that you can get fair and real information, even when you go to social media, etc. I think that raises a lot of questions, which I think need to be answered by our rules. I think the last aspect I want to mention is that I said a moment ago, it's great that digital actually allows more cross-border. But of course, that also means that, let's say, marketing is much more cross-border than it was maybe still a decade ago. And that also raises new questions as to, well, which rules apply? How do you make sure that people are actually equally protected when they shop from Brussels to Brussels, then or to Portugal or to Lisbon? So I think also the whole in market integration and the whole idea of the single rule book, which was mentioned also before, I think gets also a new meaning, and we need to look whether one needs to probably not reassess one or the other aspect of it.
Thank you, Jan. Maybe I would invite Ravi if he has some comments from his point of view, from the UK perspective regarding this linkage between the existing situation, let's say the upcoming foreseeable development in this area, and the regulatory framework that is supposed actually to fit to it.
Yeah, sure. And thank you for drawing me into this part of the conversation, and to answer it directly in terms of the marketing aspect of this. It's actually very timely for us because last month we published a consultation on strengthening our financial promotion rules for high-risk investments. The investment environment has rapidly changed, and as we've seen, as digitization increases, promotions are distributed to a mass audience at increasing speed via online platforms and through social media. There's also a risk that too many consumers are just clicking through and accessing high-risk investments without understanding fully the risks that are involved. And therefore, our existing marketing restrictions are intended to ensure consumers only access high-risk investments knowingly. But our consumer research showed that this approach wasn't working well as it should. So examples of what we are looking to introduce include improving risk warnings to help consumers better understand and engage with them, adding positive frictions to the customer journey to counter social and emotional pressures to invest and support more considered investment decisions. And we want to achieve a market where consumers invest with confidence, but understand the risks that they are taking and the regulatory protections available to them, and are not pressurized, misled, or induced to taking on investments that do not match their risk tolerance.
Thank you, Ravi. Actually, linked to that, and I would.
Can I ask a question in between? Don't want to go off script, but I just want to ask Jan and Ravi both a question, if that's okay.
Yeah.
If you look at, I mean, everything comes down with the new distribution models on product governance, right? And I mean, the product governance rules have been quite clear, and I think ESMA also published like a lot of guidance on these product governance rules. But if you look at local national competent authorities, you see that there's quite a difference still between how to basically make sure that's implemented. Some NCAs are very rule-based, some of them are more principle-based. I was just wondering, I know, for example, the FCA is a lot more rule-based. We are regulated, amongst others, by the AFM, which is a lot more principle-based. So Jan and also Rafi, how do you see that being coming together basically in a fragmented European environment where you basically have to deal with local NCAs and their interpretation of these rules?
I think that's a very good question, and we also asked this indeed in our consultation on the retail investment actually, and I think we did have quite a number of stakeholders who said, well, maybe there needs to be a greater amount of convergence there. I mean, I think you know probably that in many other areas, and you probably know the rules better than me because you are actually you're applying them every day. You know that in many areas we have really strongly harmonized rules. I think in marketing and distribution so far, actually, this is not really the case because it was always considered like a local issue. I think that is probably changing to a certain extent. And so I think, I mean, some of the answers is maybe to try to have further convergence here, or let's say, and the another question which you look at is to strengthen the cooperation there basically between different national authorities. So where you cannot actually reach kind of agreement that things should be done more the similar or the same way, then at least you may need to make sure that the authorities speak to each other from different member states and that they can resolve the issues, and that indeed, ideally, you don't have to comply twice.
Yeah, very clear, especially that collaboration issue that currently still a little bit exists, but is definitely being resolved more and more, I see. Is, I think, very critical in this. Yeah, I agree.
Yeah, just to add to that, and yeah, again, very good question, and particularly kind of highlighting where we've kind of come from. Probably traditionally quite a rules-based approach, but we're increasingly moving towards a regulatory framework which is more principles-based, particularly with new types of regulation. So when I think about the upcoming in-flight consultation on consumer duty, that's certainly been the case of being very, very outcomes focused. And to the point of regulatory cooperation, that's certainly the space that we have been playing into over the last several years. So if I think about the Global Financial Innovation Network, which is a global multilateral platform that the FCA actually leads with 12 other regulatory jurisdictions, that really enables us to work with, understand the differences between our regulatory approaches, the differences even when it comes down to how we approach emerging technologies as well, sharing those learns, conducting proof of concept testing with mechanisms like our cross-border testing, allowing multiple jurisdictions. And I suppose based on what I'm sharing there, that also signals the intent for the FCA to collaborate beyond the UK, but also equally the intent for other regulatory jurisdictions to cooperate with us and the wider membership.
Thank you.
Thank you. Yeah, if I may
just add one thing.
Yep, Jeff, please.
Sure. In the U.S., we're dealing at Schwab, we're dealing with this question in a way that we think that the rules should be technology neutral. We have, between a broker dealer and investors, we have a whole panoply of rules that govern the relationships, and they've been worked on over the years. And yes, we have new technologies, but that doesn't change the relationship between the broker and his client. You have to, and so those rules should be interpreted to cover the new technologies. And technology shouldn't be allowed to circumvent the rules. And certainly we think that that's not the case. But what we really think is that the principles are already there. Let's make sure we don't need to add rules on top of rules. Let's interpret the rules to make sure we capture what the new technologies are doing to investors.
Thank you, Jeff. And actually, those are very good comments, basically linked to what I wanted to now address with Stasis, because I think, and it has been touched by a couple of previous speakers, about how we actually make sure that this is very often one of the key concerns that we are discussing in the European Parliament. How can we ensure that in the competition and the choice, but at the same time to ensure that we have appropriate level of customer or investor protection and redress. And I think those were exactly points that Jeff also has just raised. So Stasis, what would be your views in this regard?
Yeah, thank you, Andre. Very good discussion. That's actually coming to my view that I'm looking into finance from both structural point of view, but also from the behavioral or cognitive or psychological point of view. I'm trying to merge that. So what Travi was telling resonates with me, and it's not an accident that probably that he represents the Financial Conduct Authority. And that's the authority that we're missing, I think, big time in the European Union. As speakers already mentioned, panelists already mentioned, it's at the national level, national competent authorities. And based from my experience, you mentioned when you introducing me, I dealt with the former crisis, and I saw a problem that, in a sense, a supervisor, national supervisor, colluded with the industry, at least in certain respects. And in this collusion, consumers have no chance because if they try to address some problem, the industry representatives, not all of them, of course, they respond in an aggressive way. And in the recent case I had several weeks ago, several consumers addressed the commercial bank, and they quoted the parliamentary inquiry, statements, and the bank responded quite aggressively, threatening them, even with lawsuits, etc. So, that's of course the fundamental problem I think that we have, and with the advance of technology and changing or developing products and merging products, and also merging finance and non-finance, I think it's really a challenge for the fragmented architecture on the business conduct supervision that we have in the European Union, and at the systemic level we don't have any at all at the European level. I think we have to start again. I tried to initiate the discussion at the beginning of this term, the mandate. What about this Twin Peaks model? Prudential supervision and business conduct supervision. But with all these changes and the innovation, I think this discussion is more relevant than ever. So my first response is, let's start to think about European business conduct supervision and business and financial consumer protection. And then based on that, I think, it's good for the business as well, because the fragmentation and the arbitrage opportunities are good for some short-term players, but for long-term players, who need to build their reputation based on the, coherent principles, I think it's not good either. So I won't expand any further, but that's the key issue, I think, that we don't have. And these institutions, supervisory institutions, and Mr. Kampa, talked very well before this panel about these issues. But his institution is responsible for one part of the industry, and the industry is integrated, right? So some of the guidelines that are issued are good, but the enforcement of these guidelines is quite problematic. And EIOPA is doing something on the insurance, on integrating insurance and investment products, fine, but these products are merging. Payments and credit has merged a while ago, and it continues to merge. And credit and investment is also merging. You can lend, you can borrow, and you can invest. And this brings more opportunities with this distribution models. And I think this gamification and the emotional appeal. I get some messages myself from one of the neobank. It's quite strange. It's very unusual. And I think it doesn't fit the finance as far as I can understand, and try to be prudent and cautious in finance. It's not a game. It's not a video game for sure.
Yeah, thank you. And so basically, we have a clear policy suggestion here in this regard. Do you want to react to that proposal, or should we come back to it later on, either from the supervisor side or from the industry side? would that be something that would solve some of the issues that we are facing in the real world? Yeah.
I'm happy to shortly react, and I think we discussed this before, Stasis. I mean, I think on institutional side, I think we are, let's say, with the system where we are, I think we had at some point tried to have a bit more of a coherent approach here and maybe to move towards something like this. I think it was not possible. So I think we are trying within, however, the institutional system as it stands to kind of encourage as much as possible cross-sectoral cooperation as you can have. You know, the call for advice we on purpose addressed to all three ESAs so that they should look together actually on those matters. But then, I mean, sooner or later, the European Parliament will, of course, get additional legislative files as well. So I see it's good to see that you already have ideas there, which you can then, when we come with retail investment or other things, which you can then maybe look into that. So, I mean, I think this integration and the integrated approach, I think is all of looking at different parts of the conduct world is all in favor. And I think we need to, let's say, of course, always look at structural changes, but also to do this as much as possible as we can within the current regulatory setup.
Thanks. Thanks for the comments. And if you allow, maybe I would come back to what Jeff said in his remark some times ago, which is maybe linked also to discussion that we currently having. You said, Jeff, that in what we do in terms of regulation, we should be technologically neutral, and that the technology should not be used to circumvent the existing rules. But do you see that, for instance, some of the emerging fintech companies are actually adapting or creating even new distribution models that are maybe not known to, by the existing rules, and that actually create new business models, new ways of distribution, bring up new products. Would that still be valid? I mean, in the terms that you mentioned, that we should actually apply the existing rules that we have, or these new models would challenge them to that extent that we would really need to adjust them or introduce new ones. What do you think?
Well, I think one of the comments I heard earlier is true, that the speed of interaction, I think Ravi said this, that the speed of interaction is greatly increased by the new models, the new way of engaging with clients. And certainly that creates issues, but it's still an engagement between a firm and its clients, and they have obligations to make sure what they do is in the best interest of the client. So I don't see it as dramatically different. It's just accelerated. Now, there are practices, and we've heard the mention of gamification, and certainly that is something that is being reviewed here in the U.S. A lot, because the GameStop issues of a year ago raised a lot of questions about just what types of engagement are firms using with their client, and are they using behavioral economics? Are they using nudges, behavioral prompts, in order to induce clients to do things that they may not want to do, excessive trading in complex securities that they may not be aware of the risks. Those are things that are very possible. And then use of things like confetti when you have a successful trade, or lists of hot stocks by fellow clients of this firm that create the FOMO, fear of missing out. That is certainly something that has to be looked at. But what the regulators are looking at here, what the SEC is looking at, are those prompts, those nudges, recommendations in the way of the old school of you're recommending a security, or you're recommending a strategy for trading. And that's a real interesting question, because yes, if you nudge someone and you have a good idea that they're going to take action, it can be called a call to action. It could fall within the definition of a recommendation. And then, of course, far greater rules apply. In the US, it's regulation best interest, and you have to make that recommendation in the best interest of the client. But for example, they're also talking about even colors. that if you have a specific color on your website, does that create a dopamine nudge that induces people to do things? Well, we might be getting a little far down the line of what our actual, inducements to trade. So that's where, but this is all being analyzed here. There's no answers yet. The SEC is undoubtedly going to come out with rule proposals this year, and we'll be taking it up then.
Yeah, I see also Ravi is asking for the floor, but maybe just quickly coming back, Jeff, to what you have just said. Do you have any expectations when it comes to the rules that should be introduced, or are there any views on what actually should be done by the U.S. authorities in terms of the rule book, or just sort of covering this aspects of digital engagement with clients?
Well, we have concerns. It goes to my point about new rules and the rules being technology neutral. We believe you can use the current rule set to govern digital engagement practices, and so we would be anticipating that the SEC would interpret certain practices as falling, for example, as a recommendation to a client. So we think that's undoubtedly going to come there, but it's a slippery slope of what are recommendations and what are not, and where that line is going to be drawn, I can't tell you. That's going to be a complex endeavor.
Thank you. Ravi, you asked for the floor, so please.
Yeah, so I just wanted to pick up on a couple of strands in terms of what's been said. I think this is a very interesting and useful debate as well, particularly on, Jeff, what you were sharing about the technology neutral stance. And I think, here in the UK, particularly where we are facing into a whole host of technology change, particularly in the AI and machine learning space. It's certainly to ask some very big questions. And I think the thing that we recognise as a regulator here is that we can't arrive at the answers on our own. There's broad implications for a lot of emerging technologies, but we recognise that we do have a key role to play, such as the Bank of England, to really sort of determine what is the kind of what is the thing. So I think we've been quite clear out to the market that we recognise the benefits of new and emerging technologies, but we also recognise that we need to all
I'm sorry. I'm afraid
regulators or that could be posed. And that's why we work with our key partners to work through what that could look like. The other point I want to mention as well is direct engagement. So we are very proactive here in the FCA in innovation on engaging with the market. One particular area is we welcome firms who have got innovative business models, who maybe they're not quite sure necessarily where their business model fits into our regulatory regime, but they can come to us directly and ask, does this fit in? Is there a perceived ambiguity around that? And actually, how can we help them as a regulator to navigate the complexity of that? So I'll stop there.
Thank you, Ravi, and apologies. Actually, we are apparently having some technical issues with the connection on one of our sides. So apologies for that. We're trying to get as much as we can. Stasis, you wanted to react to the debate, I see. Please. Stasis, I'm sorry, your microphone. It should be fine now. Yes,
this is all right
we can
now?
hear.
Okay.
Yes.
Yeah, let me respond to this technology neutrality. I agree completely, actually. I was one of the few parliamentarians who was skeptical about the blockchain here, while legislation was going through. And that's for the reason of technology neutrality. So, but if the businesses are using technologies and they are experimenting, artificial intelligence, et cetera, and these interactions of businesses with clients are different or changing, I think the supervision authorities should use also, technology to track that. And then if the principles are universal, then that they could be embedded, the supervision could be technologically embedded in the interaction of businesses with clients. And that should be, I think, the future. Maybe it is already happening in the UK or anywhere else. China, I would guess so, I don't know. But that's the future, and if there are clear rules and if there is a technology, of course, the mismatch of the skills and the resources mismatch is a problem. I remember we had a session at the parliament here on the artificial intelligence in finance, and Jan was present also, and I asked him, where you get money, to follow what's going on with the artificial intelligence, all these data, use financial, non-financial data, and all this machine learning. And that's an issue, of course, but that's the future. That's where we should go, I think. The skill set, technologies are different when the business conduct is concerned and when the consumers are concerned. So that's, I think, the additional answer to my previous response of the architecture. Technology should be used also in the supervising business conduct.
Very good point, Stasis. Thank you for that, and I totally agree. And I think maybe we can suggest to have at some point a dedicated panel on the supervisor and regulatory technologies, which I think would be an important addition also to it. Maybe if I may use the opportunity that we have also the industry side with us and come back to you, Jorik, as a representative of FinTechs here with us. Your company started in 2014, so some time ago. Advised through articles from your experts. So if you can actually maybe demonstrate on your case what actually brought you into this decision, and what made you actually to promote this business model. What was the potential actually you saw back then? And if you maybe can compare, because I think we all agree that the pace of progress and development in this area is extremely fast. What would you evaluate this as the key trends and evolutions in the market? Also, I think to a large extent influenced and impacted by the COVID crisis.
Yeah, these are good questions. So, look, in 2014, actually, if you look at our vision back then, you look at our vision right now, it actually didn't change that much. So if you purely look at retail investing, especially in Europe, it was always a huge hurdle for people to actually start. And if you, for example, compare it to the US, Jeff, then you see that in Europe, the percentage of households that actually are actively investing in self-directed investment accounts are like a fraction of what is happening in the US. And the market is rapidly changing now. There is actually a huge need for people to start investing. And that need actually started already in 2014. Back then, everybody from a retail perspective thought that investing was something that, your grandfather did, and you need to have a very big fat wallet to actually get started. And we really wanted to make it more accessible and more intuitive and also more affordable. So we started indeed in 2014 with that mission, and of course, due to the success of Robinhood, we've been branded to European Robinhood a couple of times, which I'm not too happy with, to be honest, because we have our main flagship application is really focused on the mid to long-term investment horizon. We don't have confetti or those kind of things when you place a trade, for example. But in the end, we do, of course, believe in the accessibility and the intuitiveness and the affordability of financial products for the retail consumer. And basically, we want to give people a soft landing. Of course, the biggest hurdle, what we see, especially on the European side, is that in Europe, you always used to be very much a savings-driven culture, right? People got compounded interest, and that's the way they made money, or at least build up wealth for the future. And that has been now rapidly changing on the back of course, a negative interest rate, but also pension systems that are unstable, house prices that have skyrocketed. And now, therefore, it's more important than ever for people to start investing. So the potential was always massive, and I branded it myself a little bit the Americanization of the European investment space, where, you know, people are actually going to start investing now because they have to, and moving away from their savings account, where, especially with high inflation rates we're currently seeing, people are actually losing money effectively. Now, then the third point, of course, the whole evolution and you mentioned the COVID lockdowns. Yes, I think it goes without saying that you know, the whole COVID situation has accelerated things on this respect. And you know, we already saw these movements even before COVID happened, to be honest. But the underlying macroeconomical circumstances currently remain unchanged. So we still see this change happening. But during the lockdown, obviously, people finally had the time and put down the effort to actually get started. And therefore, you know, things have accelerated, not just for us, but for the entire industry. So that is basically what we see. When you purely look at well, FinTech, and you're asking me, Andre, of course, this question with regards to also looking at the distribution models, and Jeff, of course, and Stasis, you made very good points, right? With regards to, you know, how can legislation and regulation basically cope with the changes that are currently happening. And what we're currently seeing is that there's a large mix arriving between financial services on the one side and technology on the other side. So it's becoming more of a blend. And if you compare retail investing or brokerage, for that matter, to the travel industry or the e-commerce industry, they're very much behind. And one of the reasons probably is also the legislative framework. But that machine learning, AI, is going to be the future there as well. That is definitely the case. It's just a matter of time. And if you go down that road, then you have to follow with certain regulatory frameworks, because yeah, these technology companies are fully driven based on, you know, maximizing profitability, and that creates by default a conflict of interest.
That is actually a very, very good point, and I'm also pretty sure that this will be one of the topics that will be discussed quite heavily. But maybe if I just have one additional question, because you mentioned the point that is very often raised all across the EU, the lack of private retail investment in general, but also the sort of a general knowledge and the appetite and sort of the culture of it. Jan mentioned a while ago the work that is ongoing, and we'll see the outputs of it being, for example, the retail investment strategy, but also I think the others. Jorik, in your view and the time that you are actually active in this area, do you think there are some issues or some areas where the public policy can be helpful in sort of incentivizing the retail investor, not only bringing the regulation, but also helping actually people to be more active in this area? Are there any steps that actually maybe, or measures that may be helpful in this regard?
I think there are many steps. Look, in the end, the last thing you want is that people immediately start deep diving into a financial product which they don't know anything about, right? That is just that just creates, I think, a situation where people are doing something which they don't know anything about, and then probably even lose money. And that's the last thing you want. I think from that perspective, we as a broker want to make sure our interests are aligned. And the way you do that is by building up a long-term relationship with your customers. But to get to that point, you really need to think about education, right? The way you basically start in any market, for that matter, is not to immediately ask for a call to action from any customer, but start with financial literacy. literacy, start to make them understand what dollar cost averaging is, for example, how to build a well-diversified portfolio, how to rebalance that portfolio. And if you do that right, even the role of financial advisors are diminishing, right? Because then people can take more of these responsibilities themselves and start building wealth for the future themselves in a very, well, sustainable way. And I think there is a lot still to gain from that. Like you mentioned, of course, we started in 2014, but we're not even close to any finish line whatsoever with regards to our mission. There's still a lot of stuff to do and a lot of improvements we need to make. And there's still, especially in certain European countries, we luckily see the uptick now happening, and we see the adoption rate also increasing. And we also see that dollar cost averaging, for example, is being applied more and more. And also the role of ETFs becoming more popular, especially also ESG, ETFs, for example. And that's a good thing. But there are many countries that are still very much behind, and we still have to work together, I think, to create that market in these markets. And yes, we all have a role, I think, in that regard, because effectively at the moment, also regulators need to be, well, looking at the situation with a fair pair of eyes, that people are actually losing money right now, right? And that creating an environment where people can safely begin with an investment journey is actually a good thing, as long as we do it the right way.
Yeah, thank you, and thank you for raising that important point also in financial literacy. I think it's a very very significant area in this regard. Maybe Jeff, coming back to you, Jorik mentioned, and this is something that we hear also very often, that comparison between the investment cultures between the European Union and the US. Your company has been one of the innovators when it comes to the retail investor model. So do you find that your customers value the model? Did you promote the model of business, or what would be your comments of how you actually engage with customers? What is their feedback? And would you also see moving yourselves into even more digital environment in the coming years? What would be your sort of perspectives in this regard?
Thanks, Andre. Undoubtedly, we believe that clients like our model. They, for example, in 2021, clients brought $550 billion of net new assets to Schwab. And that's larger than many of the firm's total assets. And so it shows that our philosophy, which really is based on something called through clients' eyes, we really do look at issues as if we were the client. What does a client want? And so we engage with our clients in a variety of ways. We have branches where if you want to go talk to someone, sit down across the desk from an advisor, you can do that. We have call centers where if you want to call in and find an expert, we provide that to our clients. And then we provide digital connection. And undoubtedly, that's going to be the future. I mean, think about it. I mean, people today, especially younger people, everything is done online, whether it's shopping, getting food, paying bills, everything. So that's the future. We have to be engaged in that. And certainly we have been over the years and are continuing to put a great deal of emphasis on that. Now, how it's used is a real key. And the use of, alternative intelligence and machine learning, because as you look at your client's data, you learn more and more about what they want, and you can provide those services to them. But there are fine lines about how it can be misused. And so to us, our clients' data is the most sacred thing we hold. We hold their money and we take care of that, but also their data is critical, and we have to make sure we protect it and use it appropriately. So I just think that the model is changing. Certainly, the growth of Robinhood and other what you call neo brokers is something that we believe we've been engaged in for years, like zero commissions. Well, Schwab began in 1974 because we cut commissions when when there was a freeing up in the US of fixed commissions. And so we've been reducing them over the years. We've gone to 0 commissions. Well, that doesn't necessarily mean that it's something bad, though it seems in the US, you hear kind of that combining with payment for order flow. And there's, that there's something hidden going on with respect to how we deal with our clients. It's not true. And we could have this whole hour debate on payment for order flow if you'd like, and I'd be happy to come back for it because it's something that we've been engaged in since 1980, and we continue to believe in that model. And I think, let me just say, the biggest misconception about payment for order flow is that we sell our order flow to the highest bidder. That's not the case. It's structured in a way that all of our executing partners are required to pay the same amount. There is no difference between them. And then what we do is we compare their execution quality. We make sure that whoever gets the order flow is providing the best execution for our clients. So these are the ways that we've adapted our model. It continues to shift, but it will always be through clients' eyes.
Thank you. Thank you, Jeff. I see Yorick wants to react.
Yeah, immediately when, of course, you triggered me, Jeff, when you mentioned the payment for order flow item, obviously.
I knew I would.
No, look, in the end, we don't make money from payment for order flow. And I, of course, share your opinion that in the US, the situation is a lot different with regards to payment for order flow in comparison to Europe. And I just want to make sure that I explain why, and then I would like to hear your opinion, of course, taking that into consideration. So in the US, you've got a national best bid, best offer, right? A consolidated tape, effectively meaning that with regards to best execution, the discussion is way more around improving the NBBO in comparison to, doing, for example, post-trading assessments, which is currently the case in Europe. And obviously, with that consolidated tape, that there is a level of protection for the customer. In Europe, there's no such thing. There is no consolidated tape. And like I said, everything with regards to the assessment on best execution is happening post-trading. And even then, it's a very tough discussion to have because there are multiple reasons why, for example, at some point, the execution price can be different for one customer than for the other. For example, due to liquidity, due to the fact that there's commission to be paid, for example. A broker can always defend that. And you don't want to get into that discussion with a regulator because it just becomes a discussion from a regulatory perspective that you cannot win. And therefore, I believe in Europe, definitely there is something to say around, the role of PFOF, as well as the fact that by default, and I also like to hear your opinion on this, Jeff, if you make more from your trading venues in terms of revenues in comparison to from your end consumers, if you have to prioritize something strategically, for example, have to make certain changes and there's a limited amount of capacity that you have as a firm, where do you going to focus that capacity? What are you going to prioritize? Are you going to prioritize something for the trading venue because that makes you your money, or are you going to prioritize something for your end consumer? And that's something I'm still personally struggling with because there's never been a discussion inside, also the European Committee's current proposal for a ban, for example. But that's something I personally struggle with, next to the fact, like I just mentioned, that consolidated tape that is not there. Let's hear your opinion.
Undoubtedly, you need to have an objective standard by which to measure your execution quality. And if you don't have that, I don't know how you ever are able to justify to regulators that you've given best execution. At least that's a requirement that we have. And so the consolidated tape and the NBBO is that standard that we use. And it's captured at the microsecond level. And so that everybody, when you send your order and it gets executed, you can compare. How did we do? Now, even in the US, the NBBO is now in question, because the national best bid and offer is in question because there are, in many stocks, odd lots that are not represented in the NBBO that lie within the best bid and best offer. that don't fall within that calculation strategy. What we require our execution partners to do is to capture those odd lots and make sure they're part of their ultimate MBBO, so that we would know that we're capturing all the best offers that are, or bids that are available in order to make our execution. So you have to start with an objective standard. That's an MBBO. Consolidated tape allows you to get there. Now, I know there's a lot of discussion in Europe about creating one. I think I would wholeheartedly recommend that happen. And so now, what was the second part of your question, York?
So the second part was around the conflict of interest on a strategic priorities level.
Clearly, payment for order flow is viewed, and it is a conflict under agency principle law. It's a conflict. Anytime you receive money as an agent from a third party, you have a conflict. And so that presents us with a problem. How do we mitigate that? As I mentioned earlier, we believe we mitigate it, one, by standardizing the amounts we get paid, so that that's not the criteria by which we choose who gets to execute our orders. And then disclosure. We believe we do disclose that we receive payment for order flow, but we think that has to be more granular in the US. We think it has to come down to an order by order disclosure on your trade confirm, so that you'll see, and you'll see what you got in price improvement in the MBBO as a client, and what the firm got in payment for order flow. And just so you know, you get for every dollar Schwab earns in payment for order flow, our clients get about $7 to $8 in price improvement. So it just shows you that the conflict gets mitigated by giving the client the predominant amount of whatever is available.
Yeah, for the record, before Jan, because you raised your hand as well, I just want to make sure everybody's here aware that I'm not against or in favor of PFOF whatsoever. In Europe, Jeff, you probably are aware of this, that there's no level playing field at the moment. So in certain countries, it's not allowed. In other countries, it's very much allowed. And at the moment, in Europe, there's no level playing field on this. I do believe your suggestions completely make sense. If we all, as industry and as regulators, want to move in a certain direction, then we need to have that level playing field, but we need to resolve, of course, the conflict of interest across the board.
Excellent, Yurik, Jeff, great exchange. Let me just take back the control of the debate, because we are getting closer to the end of our panel, and I think we have a fascinating debate. I saw Jan asking for the floor. I'm pretty sure maybe reacting on the consolidated tape. But Jan, can I maybe take the opportunity at the beginning, because we have one question, and I'm pretty sure that you would be the best placed to answer that. So if I can rate that question as well, and please don't forget what you wanted to say in reaction to our exchange. And also, I think we are basically starting our final round of comments. So if there's anything you would like to also add on top of that in terms of conclusions, we'll be happy to hear as well. So let me just quickly get to the questions. The question that we got asks, what will be the elements of the upcoming open finance proposal? I assume the open finance proposal from the European Commission. And after the proposal of the Data Act, will it be proposed in the open finance to deal with a broader data access for other financial sectors than payments? So I think one of the frequent questions we discuss in the open finance context. So Jan, please go ahead.
Yeah, thanks very much. And don't worry, I will not. I couldn't discuss payment for order flow more sophisticatedly than Jeff and Yannick actually. And this is anyway now not anymore with us, but it's now with Andre and with Stasis basically, to see what they can make out of it. So I just want to make one maybe more structural and fundamental point. I mean, I think we've been talking before quite a bit about confetti and all the bad stuff which you don't want to see, but I think you still need to also see, as people are more and more moving, let's say, into this digital space and having different ways of engagement, maybe taking less advice, maybe just changing their attitude, acting faster. You need to also answer the question, well, how do you want to actually protect them and structure the environment, basically? And I think some fundamental, I mean, information is certainly key there. I think financial education, and Jorik, you mentioned that, I think is also key there also, I think the digital, let's say, the digital opportunities provide much more chances. I mean, before you needed to just work with the schools, and then after 20 years, basically, people after school, they would then kind of take out their loan or invest their money, and they have forgotten everything they learned before. Now you can actually use the digital tools to actually give them indeed education when they actually are about to invest or to make decisions. So I think quite a lot of things you can do there. But I do think also that very clear and sometimes maybe simplistic conflict of interest rules are also important there, because the whole system is so complex that it is very important to have some fundamental basic rules. And whether that's then payment for order flow, we can discuss whether that is basically the consolidated tape, which we've also now proposed in Europe, which we should promote. Let's hope that will also make advantage, whether that is the Digital Markets Act or others. But I think some very fundamental and very clear, simple rules on avoiding conflict of interest are also important in such an environment where people are increasingly actually taking their money in their own hands, if you want. That all of that is not to kind of evade the question, Andre, which you brought up also from the audience. I think indeed also data access and use can actually also be quite a good tool to improve, for example, financial advice, to have better idea of what's actually consumers' investment profile, what are the investment you already have, so what is what you still need, basically, just to give one example. But on that one, I think we are, from our side, we are really going step by step, as we had announced that many times. Indeed, data is really something which goes way across finance, is across sector stuff. So we have the Digital Markets Act already. We now have the Data Act upcoming shortly. And we have stakeholder work ongoing. We'll consult publicly. We are reviewing the PSD2, and then I think on that basis we'll see, well, what more needs to be done to really promote this data exchange and access and reuse in Europe. But I think we have not really, unfortunately, made up our mind. I would be actually much more comfortable if I were able to give you an answer now, but I think it's not an easy topic. Anyway, I do think it's one of the ingredients to achieve this, and maybe also then to conclude from my side, indeed to try to look at, well, how can you actually use this digital environment actually to help people make a better investment decisions, and in the end have a better distribution model, and not just look at basically, well, what are the bad parts of it, and what do you need to police, which you undoubtedly need to do, and where you need to be tough, and where you need to look at social media, and you need to do everything. But I think we also need to look at how can we actually give people positively the advice which they want, or the information they want, and they need to make their decisions in a way.
Excellent, thank you, Jan, for your comments, and also for your final remarks. As we still have, I think, some 5 more minutes. I think it's about time actually for each of the panelists to maybe summarize or to point out the main takeaways from this debate. So I would invite Stasis to start with the final round of comments. Stasis, please.
Yeah, really good discussion, Andre, and all the panelists, and thanks a lot for that. And we hear about this literacy, financial literacy, but as the time go, we need to go into technological literacy, at least for the dinosaurs. Myself, my son is way more literate than myself, and will continue to be so. But also the data and privacy literacy. What does it mean? The defaults, etc. All these cookies. How they are structured and what's going on. So, but that's not enough, because there are still ways to go around that, and therefore, as I mentioned in my introduction, we need systemic changes on the European levels, ideally. Rules and principles, and also institutions. I think sooner or later we'll have to go back to the Financial Conduct Authority, European. I'll continue to push on that, And as technology is moving, as I mentioned already, the supervision has to be moving with the technology and embedding and tracking and following, and then defragmenting the market, because the mismatch will continue to grow. It's always a natural gap, business is going forward, innovating, experimenting, failing, going up and down, and the regulators and supervisors respond to that. But I think we need to catch up, otherwise it could be too late, and then something unfortunately happens in finance, crisis happening, and let's stick together. International discussion and cooperation, because it's all global. You know, all these trends are global. So UK, US, and I'm mentioning China. Maybe we have to study China, what they are doing with the crypto and all the other stuff, and how they're supervising their huge market as well. So these are my comments to finalize. Thank you very much.
Thank you very much, Stasis, for your contribution. You mentioned the UK, so maybe I would then go on with Ravi and his remarks, comments to the discussion, and some final conclusive remarks. Ravi, please.
Yeah, sure. And yeah, there's probably a number of things that I've kind of really picked up on, and the running theme I think throughout all the speakers has been that recognition that, you know, technology has really fundamentally changed how we live, how we do business, and actually, you know, the pandemic has really sort of accelerated those trends to something which was already developing. We're seeing rapid adoption of new technology. We're seeing fintechs really bring new ways of offering services, products to the market, and we're seeing, you know, large institutions partnering with some fintechs and challengers to really enrich their offerings to the market. And one note I'd like to kind of leave us on really on this is that last month we published a strategic review of retail banking business models, and I think it was quite timely to do so. This is great, but what impact is it really having on the market? Is it increasing competition in the interest of consumers? And we are seeing a shift towards that. So that report actually showed that digital challenger banks now make up around 8% of the UK personal current account market. And I think the approach that we've taken in the UK, I hope you really get that sense through this dialogue, that we have to take a balanced approach of balancing the opportunities that innovation and innovative business models bring into the market, balance that with the risks that it poses, and therefore when we seek to roll out you know, large-scale technology rollouts or new technology-focused business models, do the very people really, you know, understand how that technology works, how it operates, and the risks that are potentially posed with that. So it's that balanced approach of opportunities and risks to help move the markets forward.
Thank you, Ravi. And Jeff, please, some brief remarks for the conclusion of our today's debate.
I guess what heartens me the most about today's debate is that there is now this growth of retail investing in Europe. Yeah, we think that's really critical. We say that people need to own their tomorrow, and in the current environment, it's very difficult to do that. And investing can offer that ability to save for the future. So there'll be players in the market who will take advantage of retail investors. Supervisors, regulators have to, you know, go after them aggressively, and there'll be firms though who really do know how to treat their clients with the respect and integrity they deserve, and they'll be successful. So we would welcome that.
Thank you. And Yorick, your final concluding remarks.
Yeah, I'll keep it short because we're running out of time indeed.
Indeed.
Look, I think for me, the most important takeaway, of course, look, financial services and technology is further, you know, getting mixed up, you know, in terms of the offering, and therefore more and more innovation will happen on the technology front, and legislation will have to follow those innovative developments. And the only way to do that consistently and also appropriately is by working together on an EU level. That I'm not just referring to a level playing field here. I think also the collaboration on how to approach legislation, principle-based, rule-based, etc. That's very critical, I think, towards the future, because it's the only way to collaboratively make sure that you can keep the pace of innovation. That's my main takeaway.
Excellent. Thank you, Yorick. I would like to thank you all, gentlemen, for being with us today, for accepting the invitation and for your active and I think very good participation in this panel. So thank you to all of you. I would like to thank our audience and all the participants that are following us throughout the day, and also thank you to Afore for the opportunity to have this panel discussion. And I'm quite sure that we will have some more on many interesting issues that we touched upon today. So thank you very much.